Decentralized Finance 101. So just to start off, what is DeFi? It's a big question. It's a huge area of opportunity, and it's a space that's been rapidly growing and evolving. And it is definitely something that's on everybody's radar, especially if you're in finance. And if you're not in finance and you're in supply chain or other areas, this is an area that enterprise organizations are sincerely looking into, both from the permission, private, and of course, public blockchain side. And everybody's kind of scrambling to figure out what it is. And realistically, DeFi is a movement, and it's happening around the world. And as mentioned, it's happening quick. The movement leverages various different open protocols. One of the most popular and most used currently is Ethereum on the public network side. And then obviously permission networks, you have organizations like R3 that host Corda, that offer an array of opportunity, as well as the Hyperledger projects, specifically Fabric, which I know they just recently were discussing Hyperledger Fabric 4.0. And obviously the hot topic with Ethereum is Ethereum 2.0, so on and so forth. But these open protocols leverage or offer these decentralized networks, which increase business process efficiency and ultimately result in unlocking an array of new value in the financial system today. And I'm sure that many of you have heard of Bitcoin. Some of you may have heard of Ethereum. And these are more open or public networks that you specifically had heard of. But Ethereum also has various different options within the permission or private enterprise side of the world that we participate in as well. But realistically, this movement, as it begins to shift, requires a very specific infrastructure. And the infrastructure within the financial system is obviously comprised, and I wouldn't say mimics or mocks the current day financial system, but realistically it opens it up to brand new opportunities. And therefore we often find that, this concept or this movement of DeFi is being referred to as open finance. And I guess just to start off, we want to give you a quick history and want to specify that this is a DeFi 101, and there's a lot of information to cover. So we're not really going to be going too much into the use cases that currently exist, or the use cases that are poised to exist or are being worked on, so on and so forth, or that use cases that we can work on with you. Realistically, we want to introduce you to the concept to raise your level of awareness and to really bring you into 2020, the new decade, to essentially ensure that moving forward, you have the specific knowledge and understanding that is going to be required from you as a professional in the enterprise world. So we date back to 2009. Satoshi Nakamoto releases the Bitcoin white paper. And realistically, that is kind of your first example or use case in decentralized finance, where we were leveraging the internet and now an open protocol and a new network to essentially transact or transfer value. And that value in this case was referred to as Bitcoin. And from there, 2015, Ethereum was born. And Ethereum is a very unique and interesting protocol that we'd like to consider more of a global virtual machine. And we've done some webinars in the past. We definitely suggest that, if you need a blockchain 101, that you definitely make reference to those previous webinars. But essentially, Ethereum, this global virtual machine, is also a decentralized network, and also now leverages the concept of smart contracts, which gave I guess, which ushered in an era of what they called initial coin offerings, ICOs, and helped the industry really explore and expand infrastructure, intellectual property, so on and so forth. And these smart contracts, which we'll talk about just in a minute, enable decentralized applications. 2019, just last year, couple weeks back, initial coin offerings became a very popular thing, and it was another way of instead of individual entities, if you will, or non-entities, raising capital for the sake of the development of whatever intellectual property for their use case, Now it was done more in a quote unquote traditional method that we're more accustomed today, where the tokens were being issued through a specific exchange. And moving forward into today's times, we have decentralized finance, which is now becoming what we call open finance. And like I had mentioned previously, this is a movement that's being supported by these platforms. And as mentioned, open finance, I guess, is being termed specifically because we're breaking down the wall gardens of the past, or the closed financial system that exists today, but is in current state of transition. So Ethereum, a global virtual machine, enables open finance platforms and other decentralized applications via smart contracts. And we've spoken about this on many different occasions in previous webinars, but realistically, just at the high level, when you have a global virtual machine, you have multiple different entities that are hosting different nodes, or well, I guess in the public blockchain space, we'll call them miners in the proof of work world, and obviously now at Ethereum 2.0 in the proof of stake world, where they're in charge of validating specific transactions, as opposed to a centralized entity which validates and records transactions and hosts things in a central location. So what happens is when you have all these different network participants that span the globe, and you deploy specific contracts into these virtual machines, and they hit the ledger, well, all of these contracts have specific code that follow a very specific business process that enable participants to interact with it. And the proof of transaction resides globally within all the different network participants' virtual machines. So there's really no escaping the truth from what is happening within this business process, and it allows for various different new business features to exist. So when we take a look at the evolution of the centralized and the centralized system that we have today versus an open economy, we begin to also evaluate and take a look at what was and what is now, and kind of this migration path that the world is seeing. And what we're taking a look at here is, on the far left, we have this centralized ledger. So you're an individual, you have a bank account, you want to send money to somebody, you instruct your bank to send money from your address, and you give them somebody else's address. And in between, you kind of have no idea what happens. You just anticipate that the finances get there. You know that it takes a couple of days for the money to land. And in between, unless you're involved in finance, you don't really know what's going on. You really don't have any insight. It's not really peer-to-peer, which, when you look at like Venmo, that was kind of a twist on things, right? Where we were able to now start transacting in a peer-to-peer manner. But the second you want to take money out of the Venmo system and have it land on your, in your bank account, it takes, again, a few days. So that's more of a centralized ledger, where one institution is keeping track of transactions that are happening within their own institution. And then if you're transacting with another participant who's part of another banking system or another bank, they have their own ledgers. And ultimately blockchain is born, where we have these private ledgers, and the private ledgers offer, obviously, the potential for permission private, depending. It offers some form of decentralization, not necessarily in totality, but it offers a form of decentralization where businesses can get together and begin leveraging the benefits of blockchain and the associated benefits of smart contracts for business logic. But again, the widespread adoption of blockchain is a very difficult thing, and it takes a lot of discussion and legal movement, if you will, between different public enterprise entities to get together. Who owns what intellectual property? How do we make business what business processes are going to be on chain? What information is going to be on chain? What information is not going to be on chain? When we do a ledger upgrade, or when we do an application upgrade, how does that work, who's allowed in, so on and so forth. What are the charges to the participants to leverage the network, or rather the clients. And there's just an array of hurdles that enterprise businesses have faced today. And the opening the economy, or open finance, is really looking to leverage public blockchain ledgers, where public blockchain ledgers becomes kind of like it becomes a peer-to-peer system. You can deploy your own application on public Ethereum, and people from around the world or other business entities can choose whether or not they want to participate in some capacity, right? Because it's all public. Likewise, validators and network participants remain open to the public. So there's really no onboarding of those participants. But irrespective and regardless of the matter, there's still the concept of specific information, so on and so forth, and the exposure of intellectual property within contracts. So we're in the process of opening this economy. And currently what we have today is an array of different, let's just call them, platforms that serve different purposes for different industry sectors, whether that be, in banking, lending, whether it be wealth and asset management, capital markets, insurance. And this kind of gives you the gamut of, all of what we consider finance, period, generally speaking. And what you're seeing here is, yes, we're mimicking much of what exists today, but we're redoing it in such a way where we're eliminating various different intermediaries. And at the same time, we are increasing visibility, increasing trust. And by, of course, eliminating intermediaries, we're saving time and money. And that's critical. But as always, we have to kind of explain who we are as Envision Blockchain and our position in the industry. My name is Jason Pansis. I'm a co-founder here with Envision Blockchain. As mentioned, also, a supporter of the Enterprise Ethereum Alliance, participants with the TTI. Actually have some very interesting events coming up, but we'll save that for another time. And also within the EA, the co-chair of the supply chain SIG. So we have very interesting involvement, an array of our partnerships, including with Microsoft, so on and so forth. But just for the sake of understanding who we are and what Envision Blockchain does, we are a full service consultancy and a blockchain systems integrator. And that's kind of a complicated subject. A lot of people ask us, well, what does that really entail? And really, you can think of us in two ways. We help you realize the business value that blockchain can deliver to your specific organization by either leveraging or integrating your systems with existing systems or existing platforms, or we can custom develop and then integrate with different platforms, or just custom develop, and your organization can be a platform that others leverage. So we remain very flexible in this emerging technologies market, and therefore host an array of blockchain services, leveraging various different modern cloud and on-prem solutions, and of course host various different workshops. And I guess just to give you a brief overview of what that kind of looks like, you have your company's systems, you have your blockchain component, and you have in the DeFi space the various different segments of the DeFi space. And realistically, we can custom develop an application where I guess you could make the argument that there should be another bar to the right of the blockchain piece, which would be your custom application, and it would connect to all these different platforms that currently exist in the growing space. Understanding today to understand tomorrow is always an important thing. That's how we innovate, and that's how we've constantly progressed. So we have to take a look into the current day closed financial systems limits and understand what's going on. Why are we evolving from here? I've had some very interesting experience also in finance, which we'll get to here in a second. But generally speaking, we can all agree that the current base system, we kind of have a roadblock. We don't have full transparency. We're not able to transfer assets on our own. We have to go through various different intermediaries. Hence, what we're taking a look at here is kind of this dead end, this brick wall that we can't see through. And then to the right, we have all these different types of financial intermediaries, from banks to mutual fund companies, insurance companies, so on and so forth. Well, we're not necessarily going to remove those participants, but we want to make sure that we have better visibility and timing, and of course, more efficiency within the markets. But it didn't just start here with respect to, okay, we're going from traditional system and go straight into this open financial system. Realistically, that was my old boss there on the left. He's actually not placing an order in the ring. He's actually yelling at me. I'm kidding. He's not actually yelling at me. He was actually placing an order in the ring. But that's literally, where my financial career started. Literally trading energy futures on the NYMEX. And I worked there literally until the very last picture. That's what it looked like kind of at the end. There was, one-man show, last man in the ring. They combined all of the energy floor with NYMEX with COMEX, and this is obviously now all part of CME Group. But realistically, a client would have to place a call, to JP Morgan or Goldman or whoever it might be, who would place the call to the exchange floor. Clerk would answer the phone, send a message, signal over to the broker or whoever it might be to essentially place an order in the ring, and they'd have to find the market for it. And the internet kind of started moving that process along so that we can, we saw even in a centralized system in a closed financial market, the closure of a lot of these central exchanges. So again, closed finance has these technological limitations. And what we're looking at here on the top left is an example of a traditional economy where you have lenders, borrowers, and obviously just individuals who are looking to potentially save, right? So you have interactions between the savers, the banks, and the borrowers, where the savers can technically be considered kind of like today's stakers, if you will, which we can get to maybe in another webinar. And of course, you have your banks, and just in any good economy, you have your credit and debt market, where you have your borrowers and your lenders. Some statistics there on the lower right. I don't want to go through everything, but these are the general complaints. But the bottom line is that the current day system incorporates a lot of manual processes. A lot of the tooling remains siloed, and as a direct result, just as we were talking about before, the common theme is that this is costing time, and this is obviously costing money. We're talking about decentralized finance period, right? So time is money. And DeFi is obviously in a rapidly evolving space as a direct result. So where does open finance come in, and what does it really look like? Briefly before, we showed you a bit of a snapshot of the overall evolution, or the current day, I guess, the map of current day platforms that exist, as it pertains to industry sector or industry vertical within finance. But how does the whole thing fit, right? You have Ethereum as a layer, you have, all of these, you have this in-between layer of, we'll just call those, your basic credit market, and collateralized debt, lending, and borrowing, your credit debt market, so on and so forth. And then of course on top you have, your application layer, which is really where, your enterprise organization, your business can come in to begin either leveraging current day solutions, or we can help develop different things. Likewise, we can help develop things even, underneath in the, with respect to different, credit and debt applications, in the event that you are in the enterprise finance world as an institution. That may be something that you're specifically interested, instead of going through another entity, which is something that we've had different conversations with, especially as it pertains to, collateralizing debt, so on and so forth. And then of course above, you have your user aggregation layer, which is really where, various different other applications fit, and where a lot of liquidity is going to wind up coming into the market. So with that in mind, now that we kind of understand where we were and where we want to go, how is this going to happen? And in every good economy, we need some sort of reliability. We need, the ability to have some sort of opportunity and in participation, or realistically the bottom line, the dollar amount. But then, of course, pertaining to the dollar amount. So if you have the ability to make money, you have to also have the ability to hedge and to manage risk. And then within that, you also want to make sure that your finances are safe. So with that in mind, this slide is really mostly about liquidity. And liquidity is of course the ability to move large sums of capital or commodities, however you want to look at it, equities, so on and so forth, derivatives, whatever the case, whatever market you might be specifically referring to, in such a way that you can move a significant amount without moving the market so far out of proportion that it's out of value and your orders aren't filled. The economy needs to move, so to speak, and obviously the economy is many trillions of dollars, and as a direct result, in order to support that economy, we're going to need a large sum of capital injection to, of course, come in. And with that in mind, how do we get that large sum of capital to come in? Well, obviously you need speculators and you need investors that actually see that the risk to reward is beneficial, and you need market participants to begin recognizing the actual value and what's at stake prior to them getting involved. So providing opportunities is a significant portion of driving liquidity to firm up what we would call a good economy. And of course, like we had mentioned, your risk management and diversifying various different portfolios. The open financial market is going to give way to brand new digital assets that the world has never even conceptualized or seen, and avenues for trading that not only eliminate middlemen, but eliminate middle commodities. Instead of, there's going to be new trading pairs. You can be able to theoretically trade from commodities straight into the equities market or straight into, the stock or bond market, and be able to maneuver, through markets that we've never seen, therefore allowing various different, financial participants the ability to manage risk in brand new ways. Likewise, regulatory safety in making sure that organizations are not bad actors is a big discussion within blockchain, and making sure that the regulators are properly on board with the various different market participants, specifically financial institutions and different things like that, who need proper accreditation to help drive a good economy is going to, of course, start giving way. And we started seeing that a lot last year in 2019. There's certain organizations, no names mentioned, that really, I guess, brought concern to various different government entities, and of course, have forced them to start paying attention to re-regulating or finding ways to revise policies and rewrite laws, whether or not that those institutions are going to come to fruition or not is irrelevant. What we're talking about is decentralized finance, and that's really what's critical here, is improving the world's efficiency within finance, and that's realistically the topic that we're really focused on. And with that in mind, how is this going to develop? And what are we really developing? And again, we're not really focused on use cases for the sake of this discussion. We're really focused on how DeFi is really evolving, its adoption, and what it's doing for the open finance market. So what we're looking at here is how money moves. And beforehand, we looked at a very similar situation in the credit debt market, where you had your saver, your typical borrower, lender, and of course you had your intermediary bank. Here you're looking at two different open finance setups, if you will, where you have, of course, your cryptocurrency and your borrower who's looking to collateralize in order to take out a loan. And of course, you have your lender, which is of course providing some sort of finance. In this case, it's a deposit of fiat. And we can talk about stable coins here in just a moment. But this is essentially what's happening. But the middle component there is, of course, the shared ledger. And on the lower right-hand side, you see that that middle component is not only just the shared ledger, but it's also showing a representation of that specific smart contract. Likewise, you're seeing what they call a non-collateralized stablecoin type platform, where it's regulated by market. So this is a critical component within DeFi, just as it is a critical component in the in today's financial model as to why does money move? Well, this is demand. People need to borrow money, therefore people need to lend money, and this is the way the world works, right? We always say that money makes the world go round. So with regard to making money move and making the world go round, well, how do we solve for, how does decentralized finance and the open finance markets really solve for risk management and the ability to hedge, so on and so forth. Realistically, we're looking to drive liquidity, capital injection, so on and so forth. So we saw previously capital injection coming in, through the credit debt market. Here we're kind of seeing capital injection coming in through the elimination of various different walled gardens, and allowing different organizations to hedge in new ways via new digital asset classes, i.e., synthetic asset classes that we made reference to with respect to being able to theoretically trade stocks for commodities, so on and so forth, and for network participants or financial participants to see brand new asset classes to properly hedge. An example I like to give is, if you're an airline, you're typically buying heating oil or buying and selling heating oil against your energy position as a hedge, but that's not really a direct hedge. It's not the same commodity. In reality, your aircraft are using a completely different derivative that they call Jet A, and that's a greater refining process, which actually costs more. And on the upper right there, you kind of see that you see POS, and POS in this case stands for a proof of stake. And that's kind of, relating back to the original model of the individual who likes to save in their bank account. Well, in this specific case, just like we were talking about at the beginning, as it relates to these, public networks, you have this proof of work model today. Tomorrow, we're going to have this proof of stake model. And, the difference is that these miners are now the stakers, are capable of hosting and participating in these networks and essentially yielding a dividend or interest against the capital that they are posting or staking in this specific case. And and of course, with respect to speculation, obviously that helps on the investment side as well, right? You need network participants to solidify the markets and to create that sort of liquidity. But we, of course, need places to do this that are properly governed. And therefore, what you're looking at here is on the upper left, Backed, an organization that branched out of the owner, I believe, is also the owner of the New York Stock Exchange. And also, he was an individual who later created ICE, which is one of the first electronic commodities exchanges. And of course, you have Coinbase, which actually they had some interesting news today. And of course, in the middle between them, you have different types of stable coins, 4 different ones in this case, some which are fiat collateralized, or rather, if a bank were to issue some sort of token, or an entity were to issue some sort of token that represents $1, for example, well, to issue that token, then they would need to, of course, have that dollar as collateral. Likewise, the same principles apply to commodity collateralized stablecoins. Likewise, the same thing applies to crypto collateralized stablecoins, in the sense that you could collateralize, Bitcoin or Ethereum. And of course, you have your non-collateralized stablecoins, much like the example I gave before with Maker. And essentially, this is an avenue as to how all of these different assets are going to be exchanged, and how various different financial institutions, including investors and speculators, can begin mitigating risk in the crypto asset volatility. Meaning, the prices of these cryptocurrencies, i.e., let's say, Ethereum in this specific case, have historically been a little volatile, and I know that we're over. My apologies on that, but I know that these crypto assets have been volatile, and it's a common complaint that we've encountered when speaking to various different financial institutions. My typical response is always, well, I mean, an airline, going back to that example, needs to hedge against fuel, and their costs associated there. Ultimately, in the event that businesses are going to be leveraging public mainnets, they're going to need to find a way to hedge against the volatility of the underlying commodity, such as Ethereum in that case, which also has its gas charges to help and facilitate various different transactions on that network. So in this specific case, leveraging these different stablecoins allow them the ability to remain invested in the open finance market, without going back through the off-ramp into the fiat world, so to speak, and creates additional liquidity for that market. So we also now have these concepts of decentralized exchanges, where, in order to exchange various different digital assets, you have the ability to lock assets into I guess, different smart contracts and participate in a decentralized manner, rather than, sending to one central server location where that server may be in jeopardy or at risk of being hacked, and therefore, as opposed to the other two entities, i.e., the centralized entities in the exchange space there that we showed, Bakkt and Coinbase, those are both regulated entities. In the event that you're going to leverage a non-regulated exchange, which we don't recommend by any means, how can you go about protecting your digital assets? And decentralized exchanges are here to begin, helping and eliminate various different additional costs related to the exchange fees. Likewise, it's there to help increase various different security parameters that we're just going through. And this screen here, proof that DeFi is developing. It's been in the news, but here's some specific insight and a brief overview, for example, of the stablecoin ecosystem, and some statistics here that really support its evolution and growth. We believe that this is the first step in driving adoption as it relates to liquidity, as it relates to the various different governing bodies and investment opportunities, risk management, so on and so forth. So the fact that we see this stablecoin ecosystem growing in such demand proves that the DeFi space is really on a very interesting path. Today's news, we happen to see literally this morning that Coinbase just recently announced its international custody services. Not that they didn't have custody services beforehand internationally, it's just that due to growing demands, they've positioned themselves in such a way that they can now provide localized support overseas. Coinbase is a US-based entity out of the Bay Area, and at this point in time, they're now going to provide localized services in Europe for various different institutions. And likewise, on the lower right-hand side, this was also just released, and this chart shows, for 2019, some basic statistics that, based on weekly transfer value. The dark blue there is the transfer value of Ethereum's cryptocurrency, although there's another stablecoin called Tether, which has clearly shown massive adoption and has outweighed the transfer value set forth by the actual transfer of Ethereum itself. And that's not to say that, that Ethereum is not doing its job. In fact, quite the opposite. You have to be careful when reading the news. These stable coins are leveraging Ethereum, therefore require Ethereum to operate. And therefore, we see that the demand is massively growing in this decentralized finance space. And obviously, as participants within the EEA, we obviously would like to mention that we see this mainnet adoption picking up, and we're heavily involved in the mainnet working group. If you have any specific questions, in addition regarding various different use cases, or you'd like to somehow get involved, in the TTI, the EEA, or in the space overall, or understand how your business really fits in the decentralized finance space, feel free to get in touch with us. It'd be our pleasure to speak with you and to have additional conversations. So we're looking forward to seeing everybody next time, and stay tuned. Always appreciate our audience. Thank you.